thanks everyone for coming along. Today we're going to run through a webinar about getting your insurances sorted in 2024. Starting the year right. We'll run through a few different things and we'll go to the next few slides and that will explain what that's about.
Perfect. So just as a disclaimer, everything in this webinar today is going to be general information only. If you want specific financial advice, please speak to an advisor, reach out to us. We'd be more than happy to help. But today, just a very general overview.
Awesome. So what we're going to discuss today is the general need for insurances. What are the certain things that you're looking to cover and why? What type of insurances are there? So there's multiple different types that we work with. So we work with about 5 different types. Why you would use them, why certain people would need them, and give you a general overview about those sort of areas. What do advisors and insurance companies need from you to take out an insurance policy? So we'll give you a general overview about what are the requirements that insurance companies need for them to be able to say, yes, we're happy to offer you insurance cover, and how we go about collecting that information to make your life a little bit easier. Then for the more experienced people, reviewing your policies, and that's more looking 2-3 years later down the track. You've got your insurance policies. What are the sort of things that are going to affect you and your need for insurances later on, and what are you going to do to change them? As Zara said, she's going to review her insurances later this year. She might be able to give a few details about why and what she was doing when she first took them out and what she's looked at over the time as well. We've also got another segment about other things we're looking to tick off this year. If you were to tick off your insurances, there's other things that you may want to consider along that. And then our last couple of ones are, how would it fit into your budget, making sure that we're able to afford the insurances today and also into the future. There's no point in taking out insurances for the next 12 months and then realizing, hey, I can't afford these anymore. What are we going to do after that? We want to make sure that what we're taking out is affordable long-term. And then our last couple of ones, how are we going to start? So how do we start taking out your insurances? Then we'll allow some time for some questions and answers as well.
Alrighty. So first of all, why do you need insurance? So there's a few different reasons why you might need cover. Depending on your situation, you might have different needs. But the first major thing is income. So an example that we like to use is if you had a car, if you had a Ferrari worth $5 million, absolutely you would not leave the parking lot until you've taken out insurance on that car. But if you think about how much money you're going to earn between now and retirement, it's likely in the millions. So why wouldn't you cover your own income? Your income is your biggest asset and it sets you up for everything in life, essentially. So making sure if you didn't have that income anymore, say due to your health or an injury, we want to make sure that you can still continue your lifestyle and covering your expenses.
I don't know about you, Azaria, but if I'm driving a Ferrari, I'm not parking in a parking lot, especially at the moment.
Good point.
The next part we're looking at is our family. If you are no longer around to provide for your family, how are they going to survive? So, if you were to have children, your partner becomes a single parent. What's their ability to go to work still? It's probably going to be a lot less if you're around. So making sure we're factoring that in as well. If you're the sole income earner for the family, that's going to be a big ticking point. But the other one that most people don't consider as well is the non-earning spouse as well. So if there is a stay-at-home parent and the other partner is the breadwinner per se, that stay-at-home parent is still providing a great service to the family. If they were no longer able to, or no longer here to provide for the family, or be unable to because of physical injury, the partner that was earning income or is earning an income would have to stay home and look after the family. So the total family picture about earning income is something you need to look at as well. It's not just the people that are earning income, it's the other people that are doing other things around to allow that person to earn income.
And another one, a pretty common one that people come to us to get insurance for is their debt. So especially if someone's recently taken out a mortgage or they've increased their debt, that's a really good time to look at getting cover. So just to Trent's example, for example, with a couple, if someone were to pass away and there's only one income earner left behind, how are they going to afford that mortgage? Is there a way that we can look at making sure that if anything were to happen health-wise or upon someone's passing, can we just extinguish that debt and make sure that that doesn't need to be worried about anymore?
Awesome. So what are the types of insurances? I mentioned earlier there are 5. pretty sure we've got them all attached here, but I'll go through the first few. So we've got our life and death or life or death insurance. The next one is your total and permanent disablement. And there's trauma insurance and child trauma insurances. So all these insurances are lump sum covers. So they're paid off as a once-off lump sum benefit. And then the last one is our income protection, looking at covering a percentage of income that's lost if you're to be unable to work.
Perfect. So starting out with life insurance, also referred to as death cover, it's exactly the same thing. Life insurance would pay you out a lump sum of money or pay that to your family if you were to pass away for whatever reason. And when we're looking at the types of things that we want life insurance to cover, often we're looking at income replacement. So especially if you have a family, if you have children, we want to make sure that your family can continue to live the lifestyle that they've been living or continue to achieve the goals that you've set. So for example, if you wanted to send your children to a private school, that could still happen. So looking at a bit of income replacement and also looking at debt cover as well. So as you mentioned with the mortgage or other debts, wanting to make sure that that's not left behind to your family.
Awesome. The one thing there as well is the terminal illness benefit. So if you were to be declared usually either 12 or 24 months left to live by a doctor, depending on which policy you have and who your policy is with, the insurance company will often pay out your life policy earlier. That way you can, if you want to, spend that money in your last few years of life with your family and really enjoy it, or making sure that before you pass away that it's actually there so you feel better that your family is going to be supported later in life. The next one is our total and permanent disablement cover. So this one pays out, again, a lump sum benefit if you were to be never able to work again. So there's a few different definitions that we won't get into tonight, and we'll be able to work that out about what's available for you and what's going to be the best one for you. But generally speaking, if you were to be never able to work ever again, we're looking at getting a massive benefit paid out, which is going to cover lots of things around mainly medical costs, our debt as well again. So if you become permanently disabled, we don't want you to be living in a home with a mortgage and having the stress of that. We want to make it as comfortable as possible. And then we're also including an income replacement portion there as well. So yes, your income protection policy, if you have one, will cover out a certain amount of cover, but we want to make sure that we're topping it up so that you still have a fair amount of your income, because your income protection is not going to cover the full amount. The other income replacement there is, as I spoke about earlier with the non-earning spouse, an income protection policy is not going to be applicable for you because you don't have an income as such. So we may increase your permanent disablement to cover some of that income replacement for your partner and so on and so forth.
And then we've got income protection. So this one would pay you out a monthly benefit if you couldn't work due to injury or illness. And generally what most income protection policies cover is about 70% of your income. So it's not 100%, it's 70% of your income. And every income protection policy can be customized and is a little bit different. So there's a couple of main things that can set an income protection policy apart. The first is the waiting period. So waiting period on income protection, generally 30, 60 or 90 days. And that's how long you'd need to be off work before you're eligible to actually start claiming on your income protection. So the shorter the waiting period, the sooner and more money you get paid through your income protection. And the other thing is the benefit period. And this is how long you could be getting paid that income protection from the insurer. So often with the policies that are in your super, they may have a 2-year or 5-year benefit period, which means that after that time, they'd stop paying you. You could also look at policies that can pay and through to age 65. So if you could theoretically never work again, then you could have that really long-term income protection, or you could just claim for a few months here and there, depending on what it is that you need. So yeah, essentially the purpose of income protection is just making sure that you can still cover your ongoing expenses, even if you're not able to earn an income through your work at that time or through your own business at that time.
Awesome. Yeah, if anyone's got any questions, feel free to fire them through. Yeah, we might be going through this a bit quicker than you might want. Yeah, if you have any questions, fire away and we'll stop and answer them. And our other cover that we're looking at here is our trauma cover. So again, pays out a lump sum benefit if you would be diagnosed with a serious illness. So each insurer typically has around 30 to 40 different illnesses they cover. The most common claims are cancers, heart attacks, and strokes. So if you're looking at having one of those illnesses, hopefully you're not looking to have one, but if you do have one of those illnesses and diagnosed with it, we want to make sure, again, we're covering your initial medical costs. We don't want you to be out of pocket. And as Azaria said, if you're unable to work, your income protection will pay you, but it's going to pay you 70%. So we'll probably top up a little bit there as well. If you've got a partner and children, we might even top it up a bit further so that your partner can stay home, look after the kids. Making sure that at least for a little while, the stresses of money is taken away, because if you're suffering one of these major illnesses, there's probably going to be a fair few things that, we want to take off your plate, and finances is one of the things that can help with that.
And then in addition to trauma for yourself as an adult, we also want to make sure that there's cover there if you do have children, if anything were to happen to your child. Because if your child were to fall seriously ill, your personal insurances wouldn't pay out, as they cover your health only. So that's where child trauma insurance is really handy. What it does is it can pay out a lump sum amount of money if your child is diagnosed with a serious health condition. So again, there's about maybe 30 conditions that are covered. Things like cancer, deafness, neurological conditions, all of those are included in that policy. So if that were to happen and you got paid out a lump sum of money, some of the things that we're looking to cover is medical expenses that might be associated with that. If you've ever had someone who's sick, even hospital parking can be expensive, so that could even factor into it. But we want to look at also taking time off work for the parents. So with a sick child, that could impact your ability to work and earn an income, and that's where that child trauma could come in really handy as well. And then, extra expenses incurred staying away from home. You might see that in some cases people need to travel for treatment or be in hospitals for long periods of time. And that's where, again, having that money from that child trauma can really alleviate some of those financial stresses that may come with an otherwise very stressful condition or diagnosis.
So what do advisors and insurance companies need from you? So there's a wide range of things that we need. So how we collect it is we often get you to fill in an online fact form with a lot of the questions tailored to what we need. So the first part is our basic personal details. So things around your assets, incomes, your debts, your age, occupation, and everything around that sort of stuff. So family information, basically, so we can tailor our advice to you personally and your situation. So it's not just a cookie cutter. Everyone gets X amount of insurances for this cover. We tailor it to your personal situation based off what we think you need. So as we've been through, there's multiple different factors that go into it. So we want to make sure that what you're taking out is exactly what you need.
Perfect. Another thing that we ask a lot of questions about is your health and your occupational information. So these are things that the insurers will ask for at application stage. And the reason it's important to get that information is that can really determine who's going to be the most appropriate insurer for you. And essentially what we do is when we get that information, we go to the insurers and say, hey, this is our client, this is their situation. What would you do with this? So in terms of a pre-existing health condition, a few things can happen. Insurers can be totally fine with it and still cover you for that pre-existing condition. They could place an exclusion, which means they don't cover that condition. They could place a loading, which means they charge a higher premium, or there's potential for declining cover in some really severe cases. So having that health and occupational information can help your advisor or whoever you're working with kind of get an understanding of what's going to be available for you, as that's really important information for the insurers.
Yeah, it's probably the most valuable thing for us as well. And it's probably the biggest tipping point between doing it yourself and doing it through an advisor. We can figure out which insurance policy is going to be the best one for you. We could work with 7, 8, 9 different insurance companies. And when we bring a proposal to you, we can say, this is why we chose this insurer, because of they're going to cover you for X, Y, and Z health condition. Even though it's a little bit more expensive than the other ones, we want to make sure that you're covered for it, where these other 4 or 5 insurers weren't going to cover you for it, even though, they might be a bit cheaper. So we can bring you that information up front so you can make that, that assessment for yourself.
Sorry, I was going to say as well, one of the things that we do, which I find that our clients always really enjoy, is we put in the document what all of the insurers said about your medical history, not just the one that we're recommending. So you can get a really good idea of how your conditions might be treated across the board in the insurance world.
Yep. Yeah, we like to stay as transparent as possible. It's not about putting your insurance with the one provider. We want to put it with the best one for you. And the last one we have is if you're self-employed, we're going to ask you a few more questions regarding being self-employed. Insurance companies like to know regarding those because of different things that come in with that. So profit and loss statements, balance sheets, usually for the last couple of years. And that can, again, differ between what the insurance companies like to offer you, because all the tricky accounting stuff that might come into it around depreciation and deductions and things like that. A lot of that stuff can be added back, but each insurer will do different things in different ways. So I was looking at one today, and there was about a $3 or $4 grand difference between one of the benefits that we're able to get for income protection to the next insurer. So one might have been, I think it was $8,000 per month, and the next one was $12,000 a month, just based off their calculations. So we're able to go, all right, first we're going to look at the health. If the health is going to be very similar across the insurance companies, maybe we're looking at the one that's going to provide more cover, because if something goes wrong, we're going to get more of a benefit out of it. Yes, you'll pay more for it, but again, we can give you that information up front so you can make that decision for yourself.
Perfect. All right, chatting about reviewing policies. This is the part that I need. So why is it important to review your insurance policies? So a few reasons for that. I'll go through the first half. Trent will go through the second half. So the first one, and probably the biggest one we see, and the one that I need to do, is based on change of income. So if you took out a policy when you were earning $50,000 a year, and now you're earning $100,000 a year, you can pretty much guarantee that you're underinsured, especially for your income protection. So a change of income is a really good trigger to have a look at your insurances and make sure that it's still at an appropriate level for your current income. Secondly, having a child, that can really influence how much cover you might need. It might be that we want to increase your life insurance a little bit. It might be that once they're a little bit older, we want to make sure that they're covered under child trauma cover as well. So always reach out if that's the case. Other family situation changes, so marriages, separations, all of that kind of thing can influence your how much insurance you might need or what kind of features you might need. So just reach out again. And also new or increased debt. So taking out a mortgage for the first time, doing renovations and taking out further debt, or anything that might involve increasing or changing your amount of debt. Could even be decreasing debt. If you pay off your mortgage, maybe you don't need as much cover anymore. So that's another thing to think about as well. Sorry, Trent, I just realized I stole your first point.
Yeah, you're stealing my point. So yeah, just like increasing debt, decreasing debt affects it the same way. Do we need that amount of cover anymore? Do we decrease it? Do we leave it the same? Because at the end of the day, you might actually want to leave the level of cover to do other things with it. So it's not a hard and fast rule. I've got no debt or I've got reduced debt that you need to reduce it. You might have different financial goals at that point, but always something to review. Other things to take into consideration, especially over the last 12 months, is inflation. So what's going to happen is typically your policies will increase with inflation for the most part every year. And that's determined by the insurance company at the time of your renewal. The other part is inflation might also be eating away at your benefit as well. So 12 months ago, you might not have needed as much to get through your cost of living. Now, 12 months later, things are completely changed. Everything's costing a little bit more. You might want to go, now my income and need with my permanent disablement, my trauma, or my life policy, maybe I want to leave a little bit more for my family, knowing that things are changing in the future as well. Health improvements. So health improvements are really big around if we've got exclusions or loadings or decline as well. So if typically over time, we're able to review any exclusions or loadings you have, and we might actually be able to take them off. So the two main exclusions we usually see are people with back exclusions from usually sitting at a desk all day or doing hard labor or playing sport, and mental health exclusions. So typically as soon as you see any sort of specialist or have any sort of symptoms with those two, the insurers are pretty quick to exclude those from your policies. What we're often able to do is over a period of time, if you don't have any symptoms or treatment, what we're able to do is potentially review those and have them removed. Insurers will be able to tell us what that review period is, and it's usually based on what level of symptoms you have. So if you've had really severe symptoms for both of those illnesses, they may say we're not going to review it. If you've had really mild symptoms, maybe you went and saw a mental health specialist over COVID is a very common one. And it was a one-off thing because you were distanced from family and were living on your own and you felt a little bit stressed. They may be coming around now and saying it was a one-off thing. COVID's no longer going on. Perfect. We can have that exclusion removed, and then you're basically covered for mental health and everything else that you're not excluded for at that point from there on in. And the other one is inheritance, similar to less debt. If you were to have inheritance and be able to pay off debt, build your assets elsewhere, maybe you don't need as much insurance anymore. So you could look at reducing that, because we don't typically want to pay for insurances if we don't need to at the same time.
All right, so other things to tick off this year. If you're hearing this webinar, you're proactive, hopefully you're going to get around to making some changes to your insurance or taking out insurance for the first time. Once you've done that, what else can you tick off the life admin list for 2024? So the first thing is a will. If you don't yet have a will in place, it's a really, really important thing to get done, especially if you've now taken out some life insurance. You want to make sure that that's going to where you want it to be. When you don't have a will, you don't have a lot of control over where that money is going to end up, whereas the will lets you put in specific instructions of where that money is going to go. So the best way to go about getting a will, I'm a big advocate for seeing a solicitor. There are a lot of affordable lawyers out there who can help you get a really watertight will in place. And yeah, having your insurances all set up is a really good trigger to get that done now that you've got those kind of things to think about.
Awesome. Then there's the super review. So often we see people coming to us and going, I looked to review my super and realized I had insurances within there. Never really thought about my insurances. So I thought I better review them before I review my super, which is a really good idea, because if you were to have insurances through your super, we may think that they're the best ones for you, especially if you're going to get declined or have exclusions or loadings. So we may actually tell you to keep them around. We can tell you what we want to do with your insurances, and that might be able to guide you with your super from there, whether you can keep where you have to keep your fund, whether you can replace it, and then you can sort out your investments from there, which way you want to go. So that's often something that people will look at after we look at your insurances.
Perfect. And once you've got your insurance in place, you've got a will, you've got your super all sorted out, you're pretty much all on top of everything. Really good time to have a review of your budgeting. What's coming in, what's going out. Maybe you've got a slight additional expense with your insurance now. How's that fitting into the budget? Is there anything we need to cut down on? How's that looking? So yeah, good excuse in general just to have a look over your expenses and see if anything needs to be adjusted.
Sweet. I'm going to go off kilter here a little bit and answer Michelle's question. I'll bring that up. So Michelle asked us, when you assist us in setting up insurance cover, is a review of that cover in 6, 12, 18 months something we can come to you with, or do we have to go and direct to the insurance company? So yeah, good question. In terms of going direct to the insurance company, I'll answer that part first. Typically, if we set up your insurances, the insurance company in general won't know who you are, won't remember who you are, and hopefully we are able to provide a better service to you. So in general, anything you have insurance-wise, come and speak to us first. If for whatever reason we have to get you to do it directly with the insurance company, which is, I can't think of any reason why we would send you on in that direction, but typically we're able to do everything that you need from the insurance company, and you won't be on hold for as long. Typically send us an email. Our phone doesn't regularly get picked up, but if you send us an email, we'll be able to help you out with any questions you have and booking in a call. So in terms of a review phone call, that is something we can do as well. So typically emailing through saying, hey, I've had a life change. This is what I'm looking to do. We'll be able to send you a link, book in a call with one of our advisors and go through what that process looks like. Do we need to go ahead and give you financial advice? Do you have everything that you need at the moment? Or is there just a couple of minor changes that we can make easily, nice and easy, and go ahead and do that for you? We can do that over a quick call and go from there.
Perfect. Another thing I'll say as well on Michelle's question that may not actually be what she was asking, but she mentioned reviewing cover in 6, 12, 18 months, just as an example. One question I do get is, how often should I review my cover? So just as we've spoken about here, for us, it's not so much a time-based thing. It's not so much every 12 months you should be reviewing your cover like you would with car insurance when you're shopping around to see who's cheapest. It's really just based on, has anything changed? If yes, let's have a look at reviewing the cover. And on the car insurance thing, so yeah, the standard approach with your general insurances might be to shop around every couple of years and see who's the cheapest. Generally with the life insurances that we look at, it is quite a process to get this cover in place, which we'll talk about in just a moment. So it's not something that you usually want to switch and change all the time. It's really just, based on have things changed? Can we look at doing a review because of that?
Awesome. So how do we fit it into your budget? So that's probably one of the biggest things that we go through in an advice meeting is we'll deliver our advice, and especially with cost of living at the moment, people will go, it doesn't quite fit in my budget, which is fine. So basically from there, we'll work through all sorts of different scenarios to make it fit your budget both now and into the future. Because as I said earlier, we want to make sure that you can afford it both now and into the future, because if you're coming back 12 months later saying, I want to cancel it, it's not going to be a great outcome for you because you're going to have no insurance in 12 months' time. Yes, you've had insurance for 12 months, but we want to make sure that you're covered long term as well, because I assume that your needs in the next 12 months aren't going to go away after 12 months. So things that we can consider.
Perfect. So a few different things. First of all is having some of the cover paid through your super, which may sound a bit confusing. It doesn't necessarily mean taking out the cover that your super fund offers. Regardless of the insurer that you go with the clients that we help, you can still pay for most of the insurance through your super fund. So if you've got an insurance policy with AIA and your super fund is Australian Super, you can still pay for quite a bit of that AIA policy through your Australian Super account. So having some of that pay through super can kind of give you that immediate relief of not having to pay for so much of that out of pocket. Trent, you want to go with the next one?
Yeah, I can go to the next one. So changes to our advice. So we are happy to make any changes to our advice. So we'll give you advice now, advice meaning about what we think is appropriate for you. If you think that is not what's appropriate for your situation, that is fine. We'll work with you to figure out lots of different things. And it's probably the things that we're going to speak about on the rest of this slide about what's going to fit your needs. You may come to us and say, I really don't want income protection because of X, Y, and Z. That's fine by us. We'll give you the risks and the rewards and what we can do elsewhere and what you might want to consider. Okay, you don't want to have income protection. Maybe you need to take out a little bit of higher trauma cover. So if you have a major illness, we have a little bit of extra buffer there. So if you're missing 12, 18 months worth of work because of this major illness, that buffer's there because your income protection is not there. We'll give you lots of different scenarios about what you want to do and what you can do, and yet point you in the right direction.
Perfect. In terms of features, so when it comes to insurance, often you've got the base type of cover, just a really basic insurance that does exactly, the basic things you need it to do. And often we'll recommend some additional features that could potentially increase the value of the policy, increase the likelihood of a claim, just a few bells and whistles that we might add on that we think is valuable for you. But if cost is a major concern, it may be that we pull back on a few of those features entirely. So that's something that we can chat with you about as well.
Awesome. And the next one fits well with this question from Krista. So I've been working the same job for a long time and luckily have a lot of sick leave left saved up. Would I still need trauma insurance? So without knowing too many details, I would say you still need the trauma insurance, but what we may look to do is incorporate your sick leave in with our waiting period for income protection. So as I mentioned earlier with the income protection, there's multiple different waiting periods. It's basically how long you'd need to be off work before your income starts paying you out. So typically most insurers will have 30 days and 90 days. Some will have 60, some have 6 months and some have 2 years. So if you're looking at those shorter waiting periods, we might go, if you have 3-4 months of sick leave built up, we could potentially move from 30-day waiting period to a 90-day waiting period. And that will again save you on premiums. So again, you're not going to get paid out for a bit of time, but if you've got sick leave built up there, you don't need to have the income protection paying you out because you have that sick leave covering that little bit of time as well.
Perfect. The other one is the type of premium. So there's actually two different main types of insurance premiums. There's a stepped premium and there's a level premium. So a level premium is generally more expensive, but it doesn't increase as much over time, whereas a step premium is quite a bit cheaper, but it will increase as you get older. So if we've been looking at level premiums, which are a bit more expensive today, and you think, yeah, I can see the benefit of having those cheaper premiums over the life of the policy, but my focus right now is really keeping my cash flow free, I'd prefer to go with the step premium and save some money there. So we can always have a play around with the stepped and the level or a combination of both.
Awesome. And I might have mentioned this one already with the changes to original advice, but taking out the more important covers, you may say income protection and permanent disablement are the two most important covers for me. I only want to take out those ones. I'm willing to take that risk on my trauma cover and our life cover. I might not have any dependents, so I might not need any life cover. In saying that, we might actually recommend that you take out higher levels of life cover than what you actually need as well, because often it's actually cheaper as well. So there might be some differences between what we think you need and what we're actually going to recommend as well, based off your premium savings for taking out more cover, which every time I go through it with a client, they're shocked about how much they're potentially saving and getting potentially $1 million of extra life cover, and yet not paying any more, sometimes paying even less.
So how to get started? We help hundreds of young Aussies, or Aussies in general, every year get insurance in place. And we'd love to help you if this is something that you're interested in and something that you're looking to tick off your list this year. So if you'd like to book in a call with us, it's a 15-minute free chat. There's no obligation. You can just have a chat to us about what your situation is. We can run you through a bit of the details about how we can help. And when you do book in that call, it can be with any of the advisors at Skye. So we've got 6 advisors currently. That call will just be booked based on who's available at the time that you choose. And then we can have a chat to you on that call. Trent, do you have anything to add to that?
Yeah, we've actually offered a couple more people jobs today. So we might have a few more advisors by the time you book in as well over the next month or two. So if it's not one of these 6 names, don't be surprised if it's a number of probably 2 or 3 others. You'll be lucky if you get Phil, or unlucky if you get Phil. He doesn't do too many new calls these days with everything else going on in the business. But it doesn't matter who you'll end up with. You'll end up getting typically the similar advice. You might get it delivered in a different manner, but the advice itself is going to be very similar across the board. So rest assured that if you're with Phil, myself, or anyone else, you're going to get as good advice as if you're meeting with someone else.
Yeah. And if you lose that link between now and the time that you want to book in a call, just head to our website and click Get Started, and you can do it that way as well.
Perfect. So questions and answers. So we've got a couple of questions in the chat. So Azaria, I'll bring up the first one. Do you want to answer this one?
Yep, sure. And if anyone has any other questions, no matter how big or small, just put them in the chat while we're here. We're happy to answer them. So the question was, what's the difference between life insurance and income protection insurance? My super has income protection insurance. Do I need to get my own income protection insurance as well? Do I also need to get life insurance? So a few questions there. The first one, what's the difference between life insurance and income protection insurance? So in the most simple terms, life is if you were to pass away, and income protection is if you were no longer able to earn your income. So usually we'll recommend both depending on your situation, as they both serve different purposes. My super has income protection. Do I need to get my own income protection insurance as well? Potentially. So that's part of our services. We'll always review the cover that you've already got in your super fund, and we'll let you know if we think it's worth keeping that or just replacing it entirely, and if so, why. So as Trent touched on before, if we're looking at new covers that are going to have exclusions, or if it looks like it's going to be difficult to get you new cover, it may be that we really just want to keep the income protection that you've got in your super fund. Or it could be that we want to keep that and top up with some new insurance elsewhere, or we think that the new insurance is going to be much better for you. So we might recommend replacing that cover entirely. Just depends on your situation. So again, reach out and have a chat and we can look into that. And do I need to also get my own life insurance? I would say, again, depends. Chances are if you've got a default policy through your super fund, so if you've just got the amount of cover that they gave you when you opened the account, I can pretty much bet that you're going to be underinsured because they only give out very small amounts of cover. So it could be that you need quite a bit more life insurance than what you've already got. And again, we can help you look into that and see what's going to be most appropriate for you.
Awesome. So the other one there as well is if your employer offers you income protection or any lump sum cover as well, we can consider what that looks like, whether you're definitely going to keep it because often you don't pay for it. But what are your other needs around that? Often that is limited cover. It might have a 2-year benefit period. There might be life and TBD for a limited amount as well. So often is the case, we might take out cover elsewhere for that. So next question, I'm going to scroll back a few slides for because it sort of fits in with this one here. And we probably could have elaborated. So insurance option ideas for people working in high risk industries. So there are the 4 insurances we've spoken about today, or 5 insurances, including the child trauma. Often is the case, if you work in a high-risk occupation, insurance companies are going to decline you. So basically, we will find out your details regarding your work and your health and combine them together, send it out to the insurance companies. Then from there, we can figure out, which insurance company is going to be the best one for you. Usually looking at health first, then occupation. All right, is there any cover that they're able to get? No, we have a few other options as well that aren't typically standard covers. So if you do work in a high-risk occupation and you don't think you're going to get insurances, there are a few other options out there that we do have. Income protection and permanent disablement are usually the first 2 to go because they're that injury-based covers. So we might look at other options around increasing trauma cover and those sort of things so that if something happens, we do have some stuff there.
Perfect. What other questions have we got?
There's one there.
Yeah, great. Should we get couples cover or separate policies if we have similar incomes? So really great question. We help a lot of couples get their insurances sorted out at the same time, and they are separate policies. So generally, maybe it's not so much of a thing these days. It's not often that you'd have a joint policy. You'll be two people with individual policies, and we'll just consider the other partner when we're looking at that cover as well. So it could be that your best option is insurer A for this, and this reason, and you need this much cover because of this level of income that you're earning, and your partner might be better suited to a different insurer with a different amount of cover. So we can look at it both at the same time, but the policies will ultimately be separate.
Awesome. So I've got a few good questions coming through as well. One from Michelle here. I'm a young person. Others my age say I'm crazy looking into life insurance this young. Is it potentially adding an unnecessary cost in a high cost of living landscape? So yeah, it's a conversation that we have often with people or people are having with their family and friends. Do you actually need it? For the most part, if you are an independent person and you want to remain an independent person, what's going to keep you being independent is an income going forward. So if you're unable to work, how does that income come in? Well, income protection is the first one we typically look at. So that's typically the way I look at it. Some people will be happy to lean on their parents and move back in with their parents. Me personally, I could think of nothing worse than moving back into my parents at age nearly 30. And yeah, living with those guys, I'd much prefer to be an independent person. If something really goes wrong, I want to continue to live where I live at the moment, live in the city, enjoy my life, rather than be relying on my parents or external factors. So that's one thing to consider. In terms of life insurance, if the questions are regarding life insurance itself, you might not need that life insurance, as we said, and we might not recommend that you take out any of that actual life insurance, but there is times, and again, we might increase your life insurance above your needs to because it's going to be cheaper as well.
Yeah, another thing I'd add to Michelle's question also is there's a lot of really great benefits to getting your cover when you're young. So speaking for myself, I took out my cover when I was 19, which was crazy young, and people definitely thought I was crazy as well. But some of the benefits of taking out that cover when you're young is that you probably have the fewest amount of health issues that you're ever going to have. So if you can get cover with no exclusions or no loadings, that's really going to set you up. If anything were to happen in the future, it might be harder for you to get cover. So having taken out that cover when you're young would really pay off in cases like that. And also in terms of premiums, I spoke briefly before about level premiums, which are priced based on the age that you take them out. So when you're still quite young, you can really see the benefit often of having that level premium because you don't see those age-based increases moving forward. So yeah, taking out cover when you're young, in our opinion, me and Trent, we're pretty young. We've got all our insurances. We think it's a really good idea. And I agree with Trent. It's really just that financial independence piece, making sure that you don't need to rely on family or friends or the government. You can always stay reliant on yourself for your financial needs.
Yeah, on Azara's point there regarding exclusions. So I didn't take my insurances out after I hurt my knee playing football at 23, 24. So I've had a knee exclusion on my policy since then. I've only just had it taken off. Being a non-manual role, it hasn't really affected me, but maybe if I was a tradesperson or something like that, where if I did continue playing footy, if I re-hurt my knee, I wouldn't be covered for it. And if I was unable to walk and go to work, I probably wouldn't be able to work as a tradie. So I wouldn't have been covered. But if I took it out before my knee injury, which in hindsight would have been great, the earlier you take it out, the better you're going to be in terms of exclusions loading. So typically your health's only ever going to deteriorate and more things are likely to go wrong later in life.
Yeah.
Quick one for you, Zara, from Garda. How can I select person to book with?
Yeah, great question. So as Trent mentioned before, all of the advisors at Skye, we have similar values, similar beliefs when it comes to insurance advice. So whether you go to me or Trent or Mark, you're going to find that the advice is more or less going to be the same. If you are really choosy on which advisor you'd like to work with for whatever reason, then just book in the call with any of the advisors at the time that works best for you. And you can always say in that call, hey, can my advisor be this person? And we're happy to send you over to them. But it might just be depending on availability. For example, Phil is the director of Skye. He doesn't do many advice meetings anymore. So he might not be available, or someone might be on holidays for a few weeks. So it might make more sense to go with the advisor that you booked the call with, but feel free to put that request in if you wanted to.
Yeah, so basically if you click on the link and go through the process and pick a time, it will automatically assign you to someone. So Azaria is going to Japan next week, so you won't get a meeting with her for a little while, unfortunately. And a question from Lydia. Do you want to answer this one, Azaria? If you set up income protection, e.g. if you're on full-time income at the moment, are you covered for that same amount if you were to be on a lower paying job or go part-time?
Yeah, really good question. So as we said before, things like income changes is a perfect time to review your insurance for reasons like this. So if you take out a cover when you're earning $100,000 and your income protection covers you for what you'd be covered for if you're earning $100,000, and then you drop down to part-time and you're only earning $50,000 a year, the insurer generally won't pay you the higher amount if you've actually been earning the lower amount. So you want to make sure that you're not overpaying for a level of cover that you wouldn't actually receive at the time of claim. So really important to have a chat to your advisor and say, hey, my income has decreased. Should we look at decreasing my income protection so that I'm not overpaying? Also, if your income increases, so let's say you're earning $100,000 a year and that's what your income protection covers you for, and then you get a pay rise to $150,000 a year, the insurer is never going to pay you more than what you were paying for in premiums. So again, really important to have a review and look at increasing that income protection. That's the kind of the short answer. I could go into the really long, nerdy answer, but I'm sure we'd be here all night if I did that. So have a chat to your advisor.
There's multiple diagrams you can go into, but yeah, there's a few things that you can consider. So maternity leave is one that they sometimes give a little bit of extra leeway. If you go on sabbatical leave or go on holidays, often they give you a little bit of leeway, but typically it's, if you're earning a lower income because of change of jobs, they're not going to pay you out. But yeah, again, speak to your advisor. They'll be able to give you a better direction on what's appropriate for you because it differs with everyone, different policies. Older policies do different ways. So something to consider. Question from Anne. If we're planning to change super funds, is it better for us to talk to you prior to switching, or would you be helping us compare the insurance between the old and the new super fund? So it is definitely better for us to do it beforehand, because if you were to move super funds and move your super from one super fund to another, your insurance premiums are going to get, or your insurance policies are going to get cancelled. And we can't bring them back once they've been cancelled. So we have seen that people get declined for certain things or unable to get certain features or benefits or get exclusions. And often is the case, we'll recommend to keep that insurances and take out new insurances elsewhere. So allow us to tell you that before you move super funds. It might take you an extra 2 or 3 months before you're able to move across super funds. So it might not be optimal for your investments, but I think with super being a long-term investment, an extra 2 or 3 months to make sure that your insurance is all right is going to be a bigger effect than that 2 or 3 months of extra investment earnings that you might have been losing in that better fund or paying a little bit of higher fees, whatever it is.
Perfect. We've got another question here from AD. I hope I'm pronouncing that correctly. And she said, how long till you get quotes? It's been over a week before I provided a lot of personal info. So really great question. The process of getting financial advice and this insurance advice is maybe a bit longer than people might expect because there's a lot of work that goes into it. So generally what we say is from the date that we get your information, so an online fact find or any further information that we might need, generally it's 6 to 8 weeks before we actually have the Zoom meeting to go through the advice. And the reason for that is, first of all, we have to collate your information. And then, as I said earlier, we send that information off to multiple insurance companies. So we de-identify it. We remove your date of birth, your last name, email, contact details, and things like that. And then we go out to the market and we say, hey, this is our client. This is their situation. What would you offer? Would you apply exclusions? Would you decline the cover, etc.? And keep in mind, we've got multiple insurance companies that we're doing that with, and they can take different amounts of time to get back to us. So then once they finally have got back to us, we put all of that information together and we use that as a basis to start building the recommendations for you. So that can guide which insurer we choose, how much cover you might need, and then we start to build that all up and put that into the document, at which point we'll contact you and say, hey, we're ready to have a chat to go over this advice. So it's not a simple process of just plugging in the numbers and giving you a quote. That would overlook a lot of the really important details that go into getting the most appropriate insurance policy for you. So it's a little bit longer, but it does mean that your application should go a lot smoother because we're going to be able to predict what that application process is going to look like and avoid any potential issues by spending that time at the beginning, having a bit more of a thorough look into your personal situation. Yeah,
the advice documents we bring you as well, as we're trying to bring them down a little bit, but they sit around between 30 and 40 pages at the moment. So yeah, it takes a little while to write them. We're hoping that process over time is going to be quicker, and we're always working towards shortening our timeframes for a lot of things because we understand that it is a painful thing. We'd much rather it take 2 or 3 weeks than the 8 or so weeks it's taking at the moment.
Yeah, and that's part of the reason Trent's hired 4 or 6 people today, something like that, trying to meet up with the demand, basically.
Yeah, for sure. So that's all the questions we have. We might stick around for a few more minutes if any further questions come through. So we've got one from Talia. What happens if your income changes in the time since you first provide the information? So if your income has changed any information that changes since you've last spoken to us. So typically the initial phone call goes through, perfect, you would like to get insurance advice from us. We send you a link to fill in an online fact form, which comes to us in PDF form. Basically, that could be, as we said, 8 weeks until the advice document. If any of that information changes, medicals, occupation, debts, income changes, just email through to one of the people that have been contacting you, any of the support emails that have been coming through, and we'll be able to send that to the right people to make sure that your advice is updated. Anywhere along the journey is fine to give us some more details. We won't make you go through the full form again. We can just change that one or two answers for you.
Yeah, we often also have the situation where someone filled out their medical information, then as soon as they click submit, they just remembered something else that they've had a procedure for, and they can just reach out to us and let us know, and we can make sure that's included in the insurance pre-assessments. Perfect. Have we got any questions that we've missed, Trent? I think we've got all of them so far. Has anyone got any other questions that they might be thinking of? Now's the time to ask. What's some questions that we often get, Trent, from our clients?
You put me on the spot. Good question.
Probably one of the ones I get, and I'm sure you probably get the same, Trent, is how much does it cost? Which is always a very difficult question to answer, because if we don't yet know your personal situation, your income, what you do for work, what your assets and liabilities look like, it's really impossible for us to know. But what we generally say to answer that question is we'll have a look at what we think is the most comprehensive and appropriate cover for you. And then we'll have a look at, how much money is going into your super each year? How much money are you able to save? What's your income? Can we get this to a level that we think is reasonable in terms of premiums? And then in that meeting, we'll have a discussion about the costs that we've put forward. And you might say, as Trent mentioned earlier, maybe that's a little bit more expensive than what I'm willing to pay, or maybe I want more cover. We can really adjust everything for you. So don't stress. It's not a take it or leave it kind of situation. We really want to work with you and make sure that we can get the premiums to something that works for yourself as well, while still being, comprehensively covered.
Yeah, for sure. So if you're looking at a surgeon who might be making $1 million a year, or a financial advisor who makes nowhere near that amount, my insurance premiums are going to be completely different to someone at that rate, because they're looking to protect a far bigger income, probably a lot more debts and those sort of things. So tailoring it to your situation to fit your needs. So it's not a one shop fits all. Question from Michelle. My partner and I rosters generally don't align during business hour. Can the initial phone call take place with just one person?
Yes, it can, definitely. So the initial phone call isn't a super, super detailed deep dive into your personal situation. All we're really doing in that call is getting a bit of an understanding about yourself. So, what do you do for work? Do you have any debt? What made you decide to look at getting your insurances sorted? Just so we can assess if we're going to be the right fit for you. And if we are, we'll give you a bit of a rundown on how our process works. So we'll have a chat about the next steps, filling out the form, what that process looks like, fees and things like that. So you'll have all of that information in that initial call. If only one person can attend, that's totally fine. You can just pass that information on to your partner, and we'll also send you through an email after the meeting with a link to get started, or find out more information on our website. So totally fine if only one person can take the initial call. It's really the advice meeting that ideally we'd want you both there for, because that's going to be a lot more tailored and personal to your situation.
Yeah, so typically we've got 15 minutes set aside for the phone call. Most phone calls go for 5 to 6 to 7 minutes generally. And I would say 75% of them are with one person. So don't feel that you're missing out on too much information at that first part if you're unable to make that phone call. So in terms of our advice meetings, so after the fact that our advice is done, typically all our advisors will do one meeting after hours to accommodate those people that rosters don't suit. often, people don't work in offices. So they can't just go on their lunch break and go to a Zoom meeting if you're out on a work site. So most of our advisors will do one meeting a week after hours to accommodate those people. So if it comes to that stage, you'll get sent a link similar to our initial phone call, and you'll have their schedule, and you'll be able to flip through and find a time that suits you over the next few weeks to a month.
Perfect.
Awesome. Any last questions coming through?
Just trying to think of what other questions we commonly get, Trent, especially on the initial call. We've got one come through.
Awesome. So how's the income protection monthly benefit predicted is the question. I'll bring it up from Brianna. So it's typically a relatively straightforward scenario. So what we look at is your income at this point in time over the last 12 months. So typically for most insurers, they look at 70% of your income. Some will look at less. Some will look at more with a few different features and benefits you might be able to add in. It's typically 70%. Self-employed people were able to add back certain things like depreciation, personal motor vehicle uses, donations, things like that. And they might take away a few things as well. So they want to make sure that your income's consistent over time. Other things to consider are overtime and bonuses, making sure if they're consistent long-term, we're able to include those. Maybe if you're only started receiving a bonus in the last 12 months, the insurance company might not want to take that on. We look at that as well. Same time we look at your occupation and your health, we'll look at what likely your income protection benefit's going to be as well. So we can give you a bit of an idea of that.
Yeah, another thing worth mentioning as well is with the income protection, a lot of the time there's a component that would go into your super fund as well. So as well as what you'd get paid personally to help cover your expenses, the insurer will also often add some money into your super fund while you're on claim to make sure that that continues to grow over time. So that's something that we can also look at.
Got a good question from Tali here. Could you provide a bit more information around insurance for children, recommended age, how it changes as they get older, what sort of things it covers? Do you want to take those, Zara?
Yeah, definitely. So really good question. The age one is a really good point that you've made. So child trauma insurance is generally available after the child turns 2. And there are cases where it can be as soon as 12 months as well. So yeah, once your child's a little bit older, then you can get the cover in place. In terms of it changing as they get older, so generally the insured benefit won't change massively. You could always decrease or increase it as time goes on if you wanted to. What was I going to say on that? I was just about to mention something. Did I miss something, Trent?
No. So basically, it covers the same sort of things as you get older. So it doesn't really change. So whatever's covered when you're 2 or 3 is still covered when you're 18. The one thing that does change with that as well is when you do turn 18, the policies will get converted to an adult policy, so they don't need to go through underwriting. Then the extra adult features and benefits will be added to the policy as well, and it'll get taken out in your child's name if that's something they want to do. So it's very good that you mentioned that it's not just 2-year-olds onwards. So there is a couple of insurance companies that do 1-year-olds, and I see someone in the one of the guys that works at one of the insurance companies that offers the 1-year-old policies in the chat as well. So he'll be happy that you didn't stumble on that one.
Yeah, definitely. And in terms of things you can use that money for, as you mentioned earlier, you taking time off work, medical expenses, travel, all that kind of stuff. So yeah, it's a really good one to have. Often you see cases where someone's child has unfortunately fallen ill and maybe they're doing some crowdfunding to raise money for that. If they need to go overseas for treatment and things like that, it can become a whole financial nightmare. So yeah, having that child trauma is just that peace of mind that you're not going to have to completely wipe out your savings if anything were to happen with your kids.
Awesome. We'll hold off for another minute or two before we move on, just in case there's any last questions. They keep popping through.
Perfect.
Awesome. So we've got 2 more slides to go through. So we might, unless any questions pop up, and fire them through if you have any. But our last 2 slides are, we'd love to hear your feedback regarding our webinars. So we want to make sure that we are providing good content. We don't just want to be here wasting people's time. We want to make sure that you're learning something. And if there's anything that you want us to present on moving forward, whether it's insurance or not, whether it's other areas of finances, let us know. if we need guests on because we're not the right people to do it, we'll get reach out to the right people to make sure that we are presenting the right things for you. Good, bad, or otherwise, we want to hear your feedback. It's all valuable.
Definitely. Perfect. And if you enjoyed this webinar and you're wanting more insurance content, we do webinars, I think every month or so now. So we've got another one coming up on the 12th of March, just a bit of an overview, everything you need to know about insurance. So if you want to join in for that one, please do. We always post on social media and our email newsletter about our webinars. So follow us on Instagram, follow us on Facebook. Send us through your email. We can keep you updated with things like that as well.
Awesome. Thanks for coming. It's always better if we have questions. It's great to see a good attendance here. So hopefully you've learned something, and have a good night, and we'll see you guys soon.
Thanks, guys.